Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Diane King Hall. Let's get you up to speed on the market action with an hour left to go in the trading week. We are seeing red across the board right now with the Dow down 110 points, the S&P 500 down 18, and the Nasdaq down 25. This on the back of a weaker than expected jobs report today. Taking a look at sectors, we are seeing tech and utility seeing the steepest losses on the day, and all yields really pulling back in a big way. 10-year yield pulling back after hitting a level we haven't seen since November of 2022. You see the 10-year yield right now at 4.07%. Well, the U.S. economy created 187,000 new jobs in July, while the unemployment rate fell to 3.5%. Job gains last month were the least since December 2020 as the U.S. labor market continued to cool. For more, let's welcome in Joe Brusuelas, RSM chief economist. Joe, the big question is, well, what does this all mean for Fed policy? How would you rate the jobs report we got today in the context of inflation?
This is about as good a jobs report as one could get. It demonstrates a gradual and orderly cooling in hiring. We got a tick up in wages, which was largely a quirk of the calendar. That's going to come back. And what you see is that in that wage environment, right, we've seen it come down from 6.4% a year ago to 4.4% now. And that's while unemployment stayed below 4%. What that means is the Fed no longer has to hike. And that's indeed good news for financial market participants and the public.
The Fed no longer has to hike. The question is, how long is this restrictive policy going to stay in place? We've got the two biggest hawks, Austin Goolsbee as well as Raphael Bostic, saying essentially that we're already in a restrictive stance, that essentially you keep elevated at these levels to keep inflation from reaccelerating. When you look at the numbers today, is that enough?
Yes, I think that is enough, and they are very restrictive at this point. We really just don't see a rate hike coming anytime soon. If the direction of spending, or excuse me, if the momentum in spending pulls back significantly, then perhaps maybe second quarter of next year, but that's at the earliest. My sense is we're going to be between 5.25 and 5.5% for some time. They're going to need to see core services ex housing really cool back towards the 2% target. Now, I got some good news for you though. New York Fed has a multivariate core trend that they take a look at. That's really the underlying trend, I think, in the preferred metric. It's at 2.94%. So we're not that far away. It'll be slow, but we'll get there.
I want to ask you, Joe, so when you look at the composition of the jobs that were added, you had healthcare adding 63,000 jobs, social assistance adding 24,000, financial activities job growth increasing by 19,000, wholesale trade rising. What does the nature of this job growth tell you about the state of the job, of the hiring that is happening and the direction of the job market?
If I may, financial market participants made way too much of the 24,000 jobs created in social assistance. If you look at goods producing, if you look at construction jobs, if you look at trade and transport, then that education and healthcare, the preponderance of jobs created on the month were in the high wage categories. I mean, you know, I can't overstate this enough. At this point, you got a 4.4% increase in wages on top of a 3% inflation. That means we're seeing real wage growth. People are actually beginning to catch up, as it were. And I do expect to see several months of very strong wage growth as households catch up. You know, what's more important, though, is that because we're seeing real wage growth, sentiment on the economy, which has been undecidedly, I mean, you can't question just how sour it is, that's now going to turn, and that's good for the spending outlook.
So there have been some people we talked to. I think one expert we talked to recently said, you know, in terms of the direction of inflation, we can't just kind of sit back and expect it to continue to cool. It has been. What do you say to that? And is the wage growth enough to not just keep up, but outpace inflation?
Okay, the policy rate is above the inflation rate. It's above the core rate. That is sufficiently restrictive to bring it back down. Moreover, I think that China, which is now exporting deflation, that will begin to show up in the data going forward. Moreover, you're going to see inside the core inflation come back notably over the next couple of months. Why? Used car prices, which had been a problem for a number of years, that's really going to correct here. And then finally, and this is more importantly, rents. You're going to see rents, the way it's measured inside CPI, really begin to accelerate to the downside. We had forecasted this. We knew it'd be a second half of 2023 phenomenon, and it's happening right on schedule. And so I'm very confident that we're going to see notable improvement. We're going to have a two-handle on CPI. By the end of the year, the core,
That's the Fed's goal.
The core PCE, you're going to see 3.5% to 4%. Not 2% quite yet. That's 2025 or maybe the end of next year. But we're moving in the right direction. And I don't think what we have to do is choke the economy. We just don't need to do it. We're going to be able to get back towards a tolerable level of inflation without creating a recession. It's what the Fed will begin calling, and I'm fairly confident in this, opportunistic disinflation, probably starting in just a couple days.
Okay.
So Joe, are you saying no recession at all?
Well, we thought that we had a 40% probability of a soft landing. That's a non-trivial probability. And at this point, we've lifted our third quarter forecast to 1.7%. So I just don't see a recession here in the near term. There are risks. You could see the price of food accelerate because of what's going on in Ukraine. You could see the price of oil accelerate for a whole host of reasons. And of course, the tightness in overall lending that we saw in the senior loan officer survey, those are all risks. But right now, it just looks to me like the economy is going to muddle through.
And so, Joe, there's the argument to be made about Fed policy still taking shape, and we've heard this from Fed officials who've said, just anywhere from a few months to well over a year. If you consider that we're on the right path right now, what's the risk down the line that the Fed has already overcorrected? Are there concerns about that with the policy not having taken its full shape or impact yet?
I think you get a 9 to 12 month lag before you see the full impact of rate hikes when they're implemented. So the real risk is that you'll see consumer and industrial demand contract further or slow further and then perhaps contract due to the lagged impact of those rate hikes. Now we get to see that data quarterly. Now this past quarter was just released on Monday. It actually looks like it's beginning to stabilize, albeit at a very low level after 2 years of really big, well, not declines, but just a slowing in growth. And that's the story of the real economy is going to be told in terms of lending on the part of local and regional banks. If the Fed's policy, the lagged impact of that policy, really takes a pound of flesh out of that lending, then we could have a very mild recession. But at this point, with it looking like it's stabilizing, I just don't see that right now.
Joe, I want to ask you about something that you've written about. So we had data out early in the week, Jolts, showing that though job openings have come down, they're still signaling a tight labor market. Right. You have around nearly 9.6 million job openings. Meanwhile, the number of people searching for work is not quite half of that number, but it's a big difference, and you tweeted about this today, that there are roughly 5.2 million individuals looking for work. You compare that to the number of job openings. You have a unique solution to this problem. Tell us about that.
Right, so normally at this point of the business cycle, we'd open up the immigration channel and that's what solved the problem. Okay, just for the sake of argument, that's not happening. I'm not holding my breath on that. Workplaces, firms have really gone quite a ways in terms of lifting wages and providing flexibility. I think a full third of all workers are now working at home. Okay, at a certain point, you exhaust that, right? Wages aren't going to go up that much more, and well, you can only work at home so much of the time. I think what's needed is we need to acknowledge the structural changes in the economy. Women are now, there are more women in school than men. More women getting college degrees. At one point, we need to reshape the economy to accentuate our most important and productive workers. Females 25 to 54. Okay. Once you go ahead and you acknowledge the obvious, then you begin thinking about what's the best solution, the most efficient solution to our workplace shortages. You need to begin to talk about childcare. Basically, 90% of men, 25 to 54 in the workforce. Only 77.5% of women in that cohort are in the workforce. Therefore, there is a significant potential gain by talking and creating a national health care plan. A national child care plan north of the border in Canada. By 2027, I understand it'll be only $10 a day for childcare.
Wow.
Now,
I couldn't even imagine that.
And when
here.
you go look at the research and do the research yourself, dig into the numbers, I mean, I think we can get an extra 7 to 8 percentage points out of the female labor force participation rate in that cohort if we were to do that. It looks to me like we know where the solution is. We just need to begin talking about it in order to arrive at an equitable compromise on how to achieve that. You know, we were talking before the show, and I mentioned that often big change occurs, not because people are altruistic or even partisan. It's because you get a unique confluence of events. In this case, we have a massive workforce shortage that then requires innovative solution. And I think actually this is something that's going to be part of the economic narrative and policy narrative going forward in a way nobody would have expected just 4 or 5 years ago.
All right, you heard it here first. Joe Brusuelas, a solution to the labor shortage in America. A big thank you to Joe Brusuelas, RSM Chief Economist. We're just getting started here on Yahoo Finance Live. Coming up, will the U.S. avoid a recession? Will the Fed hike rates again? We'll talk about how to position your portfolio for every scenario. Meantime, the average price for a gallon of gas spiking 30 cents in the last month. We'll tell you what's behind that shift. And the battle for EV supremacy heats up. Fisker unveiling its new lineup of vehicles, including a sub-$30,000 SUV. We've got the details on that and much more when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Let's do a check of the market sponsored by Tasty Trade. Looking to end the trading week on a downbeat note here with all 3 majors in the red right now. The Dow down 92 points, the S&P 500 down 13, and the Nasdaq down roughly 3 there. Also taking a look at the VIX. Let's see where that fear gauge is coming in today on the back of what has been a choppy week, up about 6% right now at 1690.
Well, the labor market showing signs of cooling today. The U.S. economy adding 187,000 jobs in July, less than expected, pointing to slowing growth. But overall, still a solid report. Wages growing slightly more than expected. That growth running faster than the Fed aimed to see as it looks to tame inflation. For more on the state of the economy, we turn to Scott Ladner, Horizon Investments Chief Investment Officer. Scott, thanks so much for joining us. So first up, I want to ask, with these numbers that we had today, I mean, the word was that it needed to come in under 200,000 for the Fed to kind of cool its heels. We know this is a data-dependent Fed. Is this enough for both investor sentiment with regard to where we think the Fed is going?
Yeah, I mean, first of all, thanks for having me. And long story short, yes. I mean, this was a good enough number to sustain sort of the economic progress and sort of in the resiliency of the economy that we've seen over these last 6 months. But at the same time, it wasn't so hot as to really kind of get the Fed's hackles up. So, in our eyes, this number coming in is just, just short of 200,000 with, with slightly stronger wages, slightly lower work week, all kind of like coming.
Oh, Scott, I think we got a little glitch there. We'll bring back Scott Ladner into this, but I know Scott sent us some thoughts on this, Akiko, and some of the things that stood out to me as he just kind of talked about was just this Goldilocks scenario is still alive. Like you had, the economy is still growing, showing job growth. You had the job market showing growth of 187,000 jobs. The unemployment rate coming in at 3.5%. So again, this is just that not too hot, not too cold kind of jobs report, Akiko. And now we want to talk a little bit about the market and the market reaction. In terms of both this report and overall, we've seen a downbeat week, but we want to go for some insight into specific stocks. We want to bring in Jared Blickery for some analysis on both the meme stock trade, and he has some other insights for us. He's joining us from the floor of the New York Stock Exchange.
Hi there, Diane. Let's take a look at the Wi-Fi Interactive. I have been tracking Tupperware stock today. It has really been flying. In fact, over the last few days, up more than 300%. That's a 3-month chart you're looking at. The latest news, by the way, this company is pretty small. It's a $250 million market cap and has been teetering on the edge of bankruptcy here. Let me see if I can pull up some of these statistics regarding the latest restructuring deal. But the bottom line is they're going to be able to postpone payments to some of their lenders for some period of time. And here are the details you can see on your screen. They're reallocating approximately $150 million of cash interest and fees. That's pure gravy for the bankers that the company's going to get to keep. They're extending the maturity of some of their debt, $348 million of principal in reallocated interest and fees. So that's going to be extended into 2027. And PIK interest, that's payment in kind. That means they can pay back without cash. They can pay back maybe in stock or preferred shares, something along those lines. Cash is king. So that will mean a lot to a company that's struggling with bankruptcy possibilities. And then immediate access to a $21 million revolving borrowing capacity. So this just perhaps prolongs things. I don't want to say the inevitable, but anything can happen here. But I think my point is that I've seen a lot of other stocks like this, former meme stock, and it has just been exploding to the upside. A lot of short interest in it, something like 30% as was calculated a few days ago by S3 Partners. And at these highs just a few days ago, the short sellers had lost about $37 million, which is quite significant because market cap on this stock is only $250 million, $250 million. So let me just show you what this stock looks like on some longer time frames. Here's year to date. You can see, well, a little bit positive there, but then you start extending out 3 years, down over 62%, 5 years. What's this pattern here? It's a deja vu all over again, pretty nasty for both the bulls and the bears. And then you take a look at a max chart. Well, this stock has been down over 99% a couple of different times here from its, 2013, 2014 peak. This reminds me of some other stocks that have also been down 99%. Let's take a look at Sirius Corporation, Siri. This ticker was actually peaking in the dot-com boom, and very recently, let's take a look at a year-to-date chart. You can see spiked up here, but has come down significantly, as oftentimes happens when you get a short squeeze. Easy come, easy go. Here's Carvana. I'm going to show you a max chart. This stock is also down, was down 99% at its peak. I should say at its nadir there. And you take a look at the year-to-date. It's been holding on to a lot more of its gains than than Sirius. But here's Nikola. Here's another one. You would say, okay, on a 2-month basis, this is a high flyer, up 369%. But then again, on a max basis, this is one of those stocks that peaked over the pandemic and crashed 99%. So my word to traders is just be wary of these stocks. They're going to be getting a lot of interest as they pop up on our trending tickers list, but these are not necessarily the best investments. As we saw with Siri, that can be dead money for decades.
Oh, I love the insight and advice. Professor Jared Blickery, thank you so much.
We are back with Scott Ladner, Horizon Investments Chief Investment Officer. We got the connection back up, Scott. So let's talk about where things are right now in the markets. You're just pointing to some of the big movers, but this was a week where we saw the remaining big tech names reporting yesterday, Apple as well as Amazon. A few things we've learned on AI specifically, because this was the first quarter, we got a better sense of monetization, is the opportunity is big, but the money isn't coming in just yet. Do you think that prompts a bit of a re-rating on some of these stocks, given the run-up that we've seen?
You know, I'm not sure if it necessarily counts for a re-rating, but it probably does count for a pause button for a little bit. You know, this first inning of this is the first inning of the ball game here on the AI stuff. And so, you know, this first inning is probably about over. You know, the speculative run-ups, we've seen them. We think actually it makes some sense in a kind of a weird sort of way, because this is going to be a kind of a mass game, and this game's going to go on for a while, and probably it does take some heft and some size to probably win at it. So we do think those larger players that really saw the outsized gains, we think that made some kind of sense. But it's probably time to press pause button on a little bit and let some of the smaller players and some of the second order effects start to take effect on the AI's theme.
Scott, did we use AI to get you back? I'm joking. I want to ask you then, who do you see as the winners in the AI race? Obviously, you know, we know there's like leaders that everyone talks about. Who would you say are the top 5 that you are most a fan of?
You know, I think I don't have a differentiated view than the rest of the market on what those kind of the first order effects are, like the first order winners are going to be. And so, I mean, it's going to be your NVIDIAs, your Microsofts, your Googles, like all the big players that have sort of the built-in advantages are going to reap like these early rewards. But frankly, I don't think that's necessarily where the really interesting plays on the AI theme are going to be. You know, those are sort of the more obvious ones, but the less obvious ones are going to be some of these second order effects. And those second order effects are going to be companies like in the healthcare space. Or the pharma space, like which ones are really able to harness the power of AI to do new drug invention and testing. Which industrial companies are going to harness AI to vastly improve their logistics and really gain margin and productivity out of that. And so it's going to be like, what companies inside the U.S. and really around the world are going to be able to harness the power that AI can really unleash and from a productivity standpoint. And those are the companies that I think are going to be the sort of the second order winners. And those aren't really uncovered just yet. That's where the work is being done right now.
Yeah, plenty of companies that are pitching themselves as the potential leaders here. Scott, we are seeing inflation moderate, but there's still a lot of data for the Fed to digest before its next meeting. So let's talk about how investors can position their portfolios. Now, before we lost that connection, you were talking about how you don't expect the Fed to hike anymore. But the question is how long we stay in this very restrictive stance. No hike, but high rates. Where do you put the money?
Yeah, look, I think that's probably the regime for the remainder of this year. The only reason that the Fed would start cutting rates before the end of the year is if we saw material economic weakness. And I really do agree with the guests you had on before me. Like, we don't see a recession this cycle, or at least coming right now. And so we don't think the Fed is going to start dropping rates until we get really into December or the first quarter next year, and they'll drop rates gradually back down towards 3% over the following 12 months or so. In an environment like that, though, in an environment where you have sort of high sticky rates for a bit, but you have also pretty strong nominal growth, that's a pretty good environment for the more the cyclical types of the economy and more small caps types of names. And those names really haven't caught up or haven't kept up with the market broadly speaking so far this year, obviously. So we think the second half of this year, assuming that growth remains fairly resilient, which is our expectation, we think that the more cyclical parts and the more smaller cap parts of the market can probably play a little bit of catch up to the Nasdaq.
Scott, let's say, hypothetically speaking, we'll play devil's advocate, if you will. Let's say the Fed is not done and September there's another hike. Where do you go? How do you position yourself?
Yeah, look, if it does appear that the Fed is going to continue to hike rates, then and do so somewhat aggressively, which is definitely not our central expectation, but certainly these things can happen. Then you're going to actually probably want. This sounds kind of perverse, but you're actually going to want to go into some sort of barbell with long-term bonds. You want a lot of duration, and things like the mega cap tech names, because at that point the market's going to start really discounting growth prospects. And so you're going to see long-term rates come down pretty sharply because the market's going to really think the Fed is going to just do anything they can do to push us into recession. And then you want the secular growers in a growth-starved environment, and that is sort of those the Magnificent Seven as they've come to be known.
Scott, what does your exposure look like right now on the fixed income side?
On fixed income side, we still like credit. We like high yield. We like fallen angels. We still like we still like loans right now. And all this is because spreads aren't super attractive, but we think the economy is just fine. And so you can clip these 7, 8, 9, 10% coupons and hang out for a little while, and that'll provide a pretty decent overall total return in the fixed income space. We don't think there's a lot of value for positioning for duration or kind of spread trades right now or curve trades right now, but just sitting there clipping higher coupons with still reasonably good credit spreads in the high yield space and the loan space, we think that's probably a reasonable way to hang out in fixed income right now.
Scott Ladner, glad we got through that glitch. Glad we got you back. Scott Ladner, thank you so much. Have a great weekend.
Thanks. You too.
All right.
Well, coming up, consumer-facing companies like Coca-Cola and Procter & Gamble are raising prices even as inflation comes down. And consumers are taking note. We're going to talk about greedflation on the other side of the break. We'll be right back.
Inflation showing signs of easing, which is welcome news to consumers. But from what we've seen so far in earnings season, many consumer giants are planning to keep prices high. Joining us now with a recap is Yahoo Finance's Brooke DePalma. I know one of those companies that we talked about heading into the break was Coca-Cola, but you've got a litany of them. And this is not welcome news for consumers. For the companies, maybe.
Right. But let's hear a little bit more, because we're seeing ultimately what happening here is these heavy hitter consumer companies like Coca-Cola ultimately raising prices, and consumers finally are putting their foot down, and we're seeing that in volume growth, or lack thereof, rather. So at Coca-Cola, let's take a closer look at pricing. We saw pricing increase 10%, but volume remaining flat. Now, in the call, they did say in developed markets like North America and Europe, they're seeing some willingness among consumers to switch to private labels, which is obviously not good news for them. And so in these particular markets, they said that our pricing is largely in place and is expected to moderate as we cycle pricing initiatives from the prior year. Now, moving right along, I mean, we're seeing this similar trend at Procter & Gamble. Their pricing up 7%, volume dropping 1%. And P&G CEO telling Yahoo Finance, ever posting its quarterly results, that this was a, quote, very, very modest decline, which they would expect with the level of pricing that they've been taking. But they did hint at more on the call. He did say that pricing isn't going away in the absolute. It's linked to innovation. So they have a very strong innovation pipeline underway, which will ultimately cost more for consumers. Conagra Brands, that's behind Bird Eyes and Duncan Hine, rather, they took a pretty significant price jump, up 17% year over year. Now, the words that they used was inflation justified. They did see volumes drop as a result of that. And as you can see there, I mean, they noted that pricing peaked in Q3 due to their actions to offset that cost of goods. And they're estimating, and as they look out to the end of the year, they're saying a slowing rebounding of volumes as prices start to wrap, but they do expect ultimately to keep up with those higher prices. And Kraft Heinz has decided to hold off to some higher prices. They did see net sales rise 2.6%, but volumes down there as well. And ultimately, the company did say that they are continuing trying to catch up with very high inflation costs, that they are a leader within the category. And so they had to make the decision, and they would do it all over again to raise prices.
Brooke, what are we seeing on the fast food, fast casual restaurants? You know, I'm thinking back to a name like Chipotle, which was one of the first to step up and raise their prices.
Yeah, well, Kiko, we saw them actually miss on same-store sales in their recent earnings report, and they were one of the first to raise prices. And earlier this year, in the springtime, they did say that they were going to hold off. But in the latest earnings report, that was in question among investors, especially on the call. They held up and they sort of defended CEO Brian Nichols, saying that I think we've proven time and time again that the brand is very strong and the value proposition is very strong. And as they get closer to that fourth quarter, we'll make a decision on exactly what we want to do on that pricing front. So investors certainly questioning whether or not that was a right choice to keep pricing in place earlier this year. But we're seeing this across the board. At McDonald's here in the U.S., they benefited from strategic menu prices and positive guest counts they called out. And earlier this week, when we talked to Starbucks CFO, they said that in the Q4, they will lapse those price increases that they took last year, and they'll see a more normalized return of price increases of 1% to 2%. But certainly what we're seeing here is a bit of consumer pushback. We're seeing sort of that make way into same-store sales as well as we do lapse these price increases that fast food and consumer giants have taken.
Yeah, I'm going to make my coffee at home. Just kidding. Today I had Starbucks, though. Friday treat. All right, thank you, Brooke DePalma. Thanks so much.
Oil prices rising for 6 straight weeks, and today's gains driven by Saudi Arabia and Russia's decision to extend production cuts. Remaining OPEC Plus members, though, deciding to keep output unchanged in a meeting today, causing prices to rally further. It comes as extreme weather poses threats to U.S. production. Let's bring in Andy Lipow, president of Lipow Oil Associates. Andy, good to talk to you today. I'm looking at where oil prices are trading today, oil futures, I should say, above that $80 a barrel mark. How supportive do you think these cuts announced by Saudi Arabia as well as Russia will be in terms of price action?
Well, thanks for having me. I think these cuts are very significant. If we look back to October of last year, OPEC Plus has cut over 5 million barrels a day from their production quotas. And these last voluntary cuts by Russia and Saudi Arabia really emphasize the point that they're looking for higher prices because the domestic budgets of these OPEC plus countries simply could not last when oil was under $70 a barrel.
So, Andy, do we expect to see oil hit $90 a barrel before the year is out?
I think there's a very good possibility, especially as we've seen Saudi Arabia take these proactive steps to get the price of oil higher. I think they'd be quite comfortable to see Brent crude oil prices at around $90 a barrel and WTI at about 85. But the market could move higher because OPEC Plus tends to be reactive. And of course, as prices rise, they're certainly going to think it's in their benefit to keep those higher prices higher for a longer period of time without triggering a recession around the world.
Andy, what are the supply-demand dynamics looking like right now? You know, on the one hand, we've got the prices above $80 a barrel. You've got the Russian cuts taking shape more. And yet you look at the demand picture, at least in China, where the biggest market is, we just haven't seen the kind of pickup in economic activity.
Well, I think that their economic activity is lagging, but we do see in the physical oil market, China is buying record amounts of crude oil and processing record amounts of that oil in their new refineries and existing refineries. So the oil market is seeing the demand. The latest cut of 500,000 barrels a day by Russia was actually impacting China at the most, because China, India, Turkey, and Bulgaria have become the four main customers of that Russian oil. So it does look to me like inventories around the world are declining and supplies are getting tighter.
Andy, I want to ask you about just the impact of heat. It's not something, over the years, I've covered crude oil, and it's not something that's been often in the conversation when you're talking about oil prices, oil inventories. What is the impact of extreme weather on that market?
Well, there's a number of impacts. The first is that in the Middle East, we see them burning more crude oil for power generation to run their air conditioners during the summer. As far as refinery operations go, refineries, like people, do not like it when the heat index is 110 to 115. They simply can't have the equipment work as efficiently. And as a result, they're cutting their operating rates, not only here in the southern US, but in places like Greece and Italy, where temperatures are even higher than what we see here in Texas.
So when you think about, refineries having a breakdown, I mean, this is already coming at a time when US inventory is low. To what extent is this, as in the factor with the heat, driving prices higher?
Well, it certainly exacerbates the problem, along with these refinery unscheduled outages that we've seen around the coast as well as in the Midwest. So as gasoline demand has increased about 3% over the last 4 weeks compared to last year, and inventories are declining, it makes for a mix of higher gasoline prices for the consumer.
Andy, I want to ask you about this. I've seen the Biden administration delaying some plans to restock the emergency oil reserves, given where prices are. They've canceled this planned purchase, the Energy Department canceling this this week. So what does that say to you? Is that a good move? I mean, considering, especially given that you see WTI heading towards $85 a barrel. What's your thought on that?
I think that the Biden administration is very focused on gasoline prices because it's such a pocketbook issue. I think the fact that the administration canceled these strategic petroleum reserve purchases of 3 million barrels a month, they're really very small in the scheme of the oil market. It's less than 100,000 barrels a day when world oil demand is over 100 million barrels a day.
Looking at gas prices right now, Andy, I'm looking at $3.80 right now a gallon. We have seen that number continue to tick up over the last few weeks. Are we going to see it push even higher going into year end, or is this just something that we're seeing given the inventory picture right now?
Well, I think over the next couple of weeks, we could see gasoline prices tick a little bit higher. We've got the bulk of the hurricane season ahead of us. in the Gulf of Mexico. But as we get into the winter months, being October for the oil market, we see that refiners are able to make the cheaper grade of winter gasoline, and that would mitigate further price rises.
All right, Andy Lipow, president of Lipow Oil Associates, thank you so much, and have a great weekend, and try to stay cool in Texas.
Thanks very much, appreciate it.
All right. Coming up, Fisker unveiling a new lineup of new vehicle models, and there's wheels for every price point. Find out how Fisker plans to compete in the EV space. That's next.
Shares of Fisker seeing steep losses in the session today, down nearly 7%, despite the EV maker posting a narrower than expected loss in the second quarter. Supply chain challenges dampened the company's full year production guidance, but Fisker's continuing to ramp up its product lineup. In its first Product Vision Day, the EV maker revealed 4 new vehicles scheduled to enter the market in the coming years. I had the chance to speak with Fisker Chairman and CEO Henrik Fisker about his ambitious lineup and why he's aiming to compete at every price point. Take a listen.
We looked at market segments that are either not really occupied or very thinly occupied or very little. So I think with the Ronin, supercar, electric supercar for $385,000, there really isn't anything there, specifically not if it's a 4-door convertible, clearly. With the Alaska here, I mean, that's the hottest segment in the US right now is pickups, but everybody have seemed to gone for this sort of $80,000 to $100,000 pickup truck. So we went in this new segment where there's none, which is $37,000 for this pickup truck. So I think, again, if when we can get these cars out fast, we have a huge potential of taking a big chunk of that segment. And of course with the Pair, I mean, that nobody has yet come out with a really exciting vehicle, electric vehicle for under 30. I mean, with incentive is $22,000, and it's so versatile with so many, unique things. Like I said, every Fisker car has at least 4 unique features nobody else have or that are best in class. And then, of course, the Ocean is now rolling out, but we got to show what's next. What's next? What are we doing next?
So, looking at the price range, right? The Ronin is, you said, $385,000, hand-built, very limited, and then you've got something under $30,000. Yeah. As you look at where the market is looking to, new EV owners, where's the biggest demand?
Well, I think the biggest demand right now, I think, on SUVs and pickup trucks. And that's, of course, also an area where you have availability. So when you're looking at electric SUVs or crossovers, that's probably where you have the most choice right now. I think the Ocean is still sitting very unique as more of an SUV in that sort of $40,000 to $69,000 price class. When you look at demand for an electric vehicle under $30,000, well, we don't know because there isn't any. I think it's going to be huge. Demand for a pickup truck that's $37,000, we don't know because there isn't any if it's an electric pickup truck. So, but we believe that demand will be there if there's a cool product.
Have you secured locations for these other cars that you say will be built in the US?
So we're in the middle of negotiation and we're in the middle of looking at different choices, and I think we will make these choices towards the end of this year. And we are looking at, it depends on which vehicle it is. Obviously the Ronin is going to be very low volume, so it's a completely different manufacturing method. When we're looking at both the Alaska and the Pair, they have to be built here in the US because we want to take advantage of the incentives. So we're looking at a couple of options, but also specifically with Foxconn, we're obviously still working on the details of the agreement because it takes quite a lot. So that takes a little bit of time to do.
So as you think about taking advantage of the incentives, because really that allows for even more affordability, does your partnership in Austria, does that still remain in play in the future?
Yeah, absolutely. Look, Europe is actually right now accelerating faster in EV adoption, specifically with our Ocean. We are getting more faster acceleration and growth in orders from Europe right now. So we need, of course, because don't forget in Europe, there's also incentives, there's logistic costs and everything else. So I expect that eventually the European facility will actually only be delivering into Europe. When we start selling more than 50,000 Oceans in Europe, that will become the European facility, and that makes sense because then you have to ship across. Now we of course, we couldn't afford to start with 2 factories, so now we are shipping Oceans to the US, but eventually we'll make the Ocean in the US.
In the future then, all cars sold in the US, made in the US?
Pretty much, except for something like super high-end, low volume, but yes, the other vehicles will be made in the US. It's a big market, and as long as we get a volume that's above 50,000 of each model, then it makes sense to make it locally, in any market really.
I'm thinking back to a conversation we had last year, right after the IRA was passed, and you raised some concerns about the requirements that were needed to tap into those incentives.
Yeah.
Have you changed your mind on that? Have you seen the kind of momentum maybe the administration had envisioned with those incentives allowing EVs to be a little more affordable?
No, I still think I still think that should have been given more time. I mean, there's other vehicle manufacturers that are planning facilities here in the US, and as I said that time, it takes at least 2.5 years to kind of get a factory from scratch up and running. And I think it would have been fair to wait these 2.5 years, but they decided to do different. Now, it hasn't really impacted us a lot. We haven't seen, I can't really say if it had an impact or not, because you never know if the growth was different. But what I will say, I think the biggest impact we have seen in the US is that when people have to wait so long for a car, a lot of people thought they're going to get their car now, and then their lease went out, so they went and got another one and say, okay, then we're going to wait. So I think that's the biggest impact we have had, to see that maybe the orders are not growing as fast as we had hoped there in the US. And then of course you see the financing of vehicles. But somebody who's buying a $70,000 car, of course they would like the incentives, but there's a big likelihood they earn too much money to get it. And there's a big likelihood they go, well, I don't really want a car I don't like just because I get an incentive.
You look at the 2 key hurdles right now to EV adoption. One is price, which you've kind of addressed here today. The other is range. You've got significant range in your cars, but there is a broader debate that's happening about charging standards. NACS and CCS, increasingly we have seen other companies go with the Tesla standard. How are you thinking about that? And ultimately, does it matter if there are two standards in place because you need all the infrastructure you can tap into?
Yeah, look, I think it's all a matter of the customer, and we are open to using any standard because I think in the end of the day, customers, they just want it easy. They don't want to have to be bothered to, what is this block? I don't have it, etc. So I think it's great when everybody opens up and everybody can use, all the chargers that are available. In the end of the day, I think that's what's going to satisfy the customer. So we are absolutely open to that. I just saw this, that some of the legacy car makers are now making also their own club and coming out with something, but I think they are using CCS, which is good news. So I think, look, if every car maker would have had their own gasoline stations, we would never have so many cars in the world because it would have been a real nuisance for people. So I think we got to get to as much standardization as we can with plugs.
But does it change the way you think about these cars? Because ultimately, if it's got to be built in.
No, we'll build it in. We're already looking at it. I think that's something, it's not that big of a deal. If you look at it, you build it in, and as long as there's only 2 blocks, I think it becomes a real problem if somebody introduces a 3rd block. You can only have so many blocks on the car, otherwise it looks like one of these squares you carry when you travel international where you have to pull something out to fit in the, in the wall.
So as long as the adapter is there.
Yeah, I think you don't want more than 2 standards. That's going to be absolutely max.
Okay, final question here. The Ocean, you had the deliveries, the first deliveries in June. The production count not as high as a lot of investors were expecting, and you mentioned parts suppliers, some of the concerns on that front. Has that been resolved?
Look, we still have a hangover from COVID. So it's not a matter of you just suddenly resolve one thing. I think we're going to keep seeing the hangover of COVID for several months, generally in the world with with all car makers, and I think you're seeing it every day. We have resolved some issues that we had already done. We still have one supplier where we have issues with ramping up, and of course we are working on that. Is there something else that's going to happen in 2 months? I don't know, but we definitely saw more issues with the hangover of COVID than we expected, clearly. But one of the good things now is we are now up past sort of where we're just making, whatever, 20, 30 cars. I mean, we are really up now to making thousands of cars. So I feel pretty good at where we are standing. And one thing that's important in my mind is it's not so much the yearly amount of vehicles we are going to deliver because we don't have a full year. I think what's important is can we get up to our daily target of 300 cars a day, which is 6,000 cars a month. And yes, we can. This we are 100% sure we can do that, and we are going to get up to that later this year.
That was Fisker Chairman and CEO Henrik Fisker. Diane, I can't stress enough how ambitious this plan is. When you think about Henrik himself said from concept to delivery, usually takes about 4 years.
Right.
They've already obviously got this going, but 4 prototypes being delivered by 2025 is the goal. The one thing we didn't talk about in that interview, though, is the range, and that's going to be a pretty attractive one when you consider the Ronin, which is, of course, the highest end, 385,000, not in my price range.
No.
600 miles. 600 miles is the range.
That
is a
amazing.
very significant range.
That is amazing.
And then the Ocean,
yes.
The Ocean SUV, which is considered the more affordable car, 360 miles. So that puts you right in that Tesla range at a much lower price point.
Right. So the price point isn't the issue here when you're talking about, anything below that super high-end flashy vehicle that they have coming up. Production is their issue. Delivering on these vehicles is their issue. I mean, look, Wall Street initially liked hearing about all of these new flashy vehicles, but it turns into a story of show me the money. I mean, their numbers didn't hit like they were supposed to in terms of their quarterly report. They lost 25 cents a share. Sales just weren't enough, especially, and they just didn't. I mean, they delivered 11 vehicles, right?
And that really points to the challenge of so many of these EV startups that have to scale up. For years, the argument has been you bet your money on a company, a legacy company like a GM and Ford, because even though they are heavily invested in gas-powered vehicles, they know how to scale up once they make the switch to EVs. It's a little harder for startups like Fisker.
Right. So it'll be interesting to see what happens next. I mean, I do like what I'm seeing. I like the price point, especially when you look at the pair.
The pair. Which, by the way, stands for an acronym. I don't have the acronym right now.
That's all right. I like all their names. Ocean, Pair, etc. Coming up, though, the closing bell on Wall Street. We are checking in on the latest market moves and some top trending tickers. Stay with us.
And the closing bell on Wall Street. We are waiting that as we wrap up the trading week. There you have it. All three majors ending the week in the red here. Let's run through some of the numbers there, because we did see the Dow down roughly 150 points, the S&P 500 down 23, and the Nasdaq down 50. This market check sponsored by Tasty Trade. The Dow, S&P 500, Russell 2000 now snapping a 3-week winning streak, and the Nasdaq down 4 straight days. We did see the yields coming up as well, but this coming on the back of a weaker than expected jobs report, which some had seen sort of favorable to Fed policy, at least in the expectation that they may not hike rates again come September. Well, shares of Amazon closing the day well in the green, nearing its 1-year high after blowing past Q2 estimates and delivering its biggest earnings beat since February 2021. The company's outlook for the third quarter was also better than anticipated. Diane, so many questions going into this quarter and those results coming out of Amazon. We were talking about this yesterday.
Yes, indeed.
Cloud was a beat. When you think about where retail came in, it was stronger than expected. Certainly things looking positive for Amazon after some of the challenges they've had to face, both on the cloud side of things as well as the e-commerce.
Yeah, and I want to talk about some of the analyst commentary around Amazon. I know we talked to an analyst yesterday, but also we had Evercore out today reiterating its outperform rating, hiking its price target on Amazon to 190 a share, saying the company addressed those concerns about retail margin, echoing comments we've heard, and AWS revenue reacceleration. JMP Securities also out with a note on Amazon today, boosting its price target less than what we're seeing at Evercore, but still higher, up to 175 a share. So, you know, also similar things, JMP Securities citing, saying it delivered the strong results, exceeding expectations, both the top and bottom line. We know that. The outlook also for the third quarter, it likes the outlook, saying that is better than anticipated. The retail business just resilient in the face of, you know, some of these macro headwinds that we've talked about. I want to switch gears and look at another company that we've been watching today. Shares of Booking Holdings trading better than the market, getting a big boost today after reporting huge revenue growth of 27% year over year. CEO Glenn Fogel says that the website is expecting a quote record summer travel season as bookings accelerate into the end of the summer. So this is a different story. Akiko, you and I talked yesterday about Expedia, a competitor. It didn't do as well. Booking, though, doing very well. I mean, it's got Priceline under its belt. It's got Kayak. It's got rentalcars.com. And I actually didn't even realize this. OpenTable is in its wheelhouse as well. So it's all over the place, whether we're talking about airlines, rental cars, reservation, just outstripping expectations. And again, you have analysts jumping on board, raising targets on this one.
This is a company that operates across 6 different websites or sites. So certainly very diversified, but it really is all about international exposure. And that's what we've seen through the earnings season in terms of those in the travel space, those who have more international exposure, who are seeing the significant demand on that side, benefiting in a big way. Booking gets about 90% of its sales from international markets. So that alone tells you why they have seen that momentum while some of its competitors have not. That stock getting rewarded in a big way today, up roughly 8%.
Indeed. CFRA research raising it from a hold to a buy on that one. TD Cowen saying the booking season continues. It's raising its price target to 3,600, saying it sees room for further upside, even to what booking itself sees. They says if macro conditions hold up, we're certainly hearing that from economists. Oppenheimer also increasing its booking price target. They're raising theirs to 3,700.
Okay, let's move on to another stock that we're watching. Coinbase shares sliding in the session today, down roughly 4%. The company reporting a narrower loss than expected, but the regulatory and legal overhang weighing on the stock. Remember the big shock that we got from the SEC earlier this year with that lawsuit against Coinbase as well as Binance, saying that they traded about 13 crypto assets that they say were not necessarily registered securities. So that overhang continuing to be weighing on the stock there. The company made it pretty clear in this earnings call, the chief legal officer saying, with respect to the litigation, I want to be very clear. We do think we can win. We expect to win. So there are still concerns about that, but the company at least putting a very strong face forward, saying, or very confident face forward, I should say, saying that they expect to win.
Yeah, and
the SEC.
To your point, I mean, Coinbase has definitely been defending itself, and you know, even analysts in this space say it's a different story than, say, Binance. But you have divergent views in terms of how you see the results. TD Cowen says, despite the beat, there are early signs Coin is losing some retail trading volume share, which it did. But their price target is sharply lowered. I mean, they're looking for a price target of $36 a share, a far cry from where it stands now. It's, you know, even despite the drop today, it's around $87 a share. You got the flip of that. JMP Securities has a more optimistic outlook on this stock. They're raising their price target to $107 a share. We'll see which one of these firms is right on this call. Akiko. All right, meantime, is the prospect of a recession quickly disappearing? Bank of America certainly thinks so. Even JP Morgan Chase now getting on board with that, having changed forecasts this week to predict for Bank of America a soft landing. But on the other hand, Fitch downgraded its AAA rating for North America. So what sort of picture does this paint when it comes to President Biden's economic plan and those all-important approval ratings? Yahoo Finance's Rick Newman has more on the latest Bidenomics. Hi, Rick.
Hey guys, it's like for the last month or 6 weeks, every week a couple of forecasters improve their forecast and come out and say, yeah, that recession we thought was right around the corner. Nah, maybe it's not around the corner. And the one that got a lot of attention this week, of course, was Bank of America. They changed their view. They said, we're flipping from a mild recession scenario to a soft landing scenario. And look at what's happening. I mean, the jobs report today, actually quite good. That slowdown in hiring, it dropped from a pace of about 270,000 new jobs per month for the first 6 months of the year, down to about 187,000 jobs. But that's exactly what the Fed is trying to do. So that looks like the Fed's interest rate hikes are working. Inflation has fallen from 9% peak last summer to just 3% now. So things are going the right way. The big mystery at the White House is, why is none of this improving outlook helping Joe Biden's approval rating? He's still at around 41%. He's seen no change really in his approval rating from a year ago to today, which is pretty weird given that inflation has come way down and we've got so many new jobs since then. So Biden has about a year to sort out this mystery and turn this around. But his mission number one as now a presidential candidate for 2024 is to get voters to give him some credit for an economy that is actually quite good.
Well, and we have seen the president stumping, right, nationally, going, touting some of the big commitments in terms of factories that have come through from his policy, whether it's the CHIPS Act or IRA. What does the polling say about how much of that message is sticking with voters who may be sort of in between?
Yeah, it's not for lack of effort. I mean, he's basically on a nationwide tour, and he will remain on a nationwide tour. And so will all of his deputies, cabinet secretaries, and so forth, bragging about everything that's going right in the economy. And it is just not getting through. So we may have seen a little bit of a breakthrough last week when consumer confidence improved. That's been a bit of a mystery itself, too, because consumer confidence has been absolutely terrible. I mean, it has been at recessionary levels, and by some measurements, deep recessionary levels, with an unemployment rate at 3.5%. I mean, that does not compute. So it's obviously all about inflation. So I think the problem for Biden is basically just getting consumers to feel like the inflation shock is over. I think even though the inflation rate is down to about 3%. I think a lot of people have inflation PTSD. I mean, it just shocked the daylights out of them, and they can't believe that we had food prices going up, rents going up. And by the way, those prices have not come back down. They have just stabilized. They're just going up by a little bit less. So one good thing for Biden is that we're once again seeing positive real income growth, which means that only for the last couple of months have incomes begun to grow by more than inflation. So consumers are finally starting to get ahead again. If they can do that for the next year, continually get ahead of inflation, maybe by this time next year, people will feel better about the incumbent president, but they certainly don't feel very good about him now.
Inflation will certainly be one to watch, especially we are starting to hear in some of the quarterly reports about some companies. We talked to Brooke DePalma about that earlier, having to pull back on all the prices because consumers are starting to be a little resistant to that. So we'll see how that factors into the economic picture. Rick Newman, thank you so much. Have a great weekend, Rick.
You too.
All right. It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Apple losing its crown, or should I say a bite taken out of Apple, falling below $3 trillion market cap. The stock sliding on the heels of its earnings. The company reporting its third straight quarter of declining sales. Apple's outlook for its fiscal fourth quarter also weighing on the stock, expecting another decline in revenue for the current quarter. Legendary investor Carl Icahn seeing his fortune decline by more than $2 billion. His company Icahn Enterprises announcing it is slashing its dividend in half to $1 per share. The move coming as ICANN is being targeted by short seller Hindenburg Research 3 months ago, which claims the company is overvalued. Since the report initially came out, ICANN's net worth has plunged $17 billion. Finally, Google scoring a victory in court in its antitrust cases brought by the Justice Department and state attorneys general. The judge narrowing the case, saying Google will no longer face allegations that the design of its search results hurt rivals, including Yelp and Expedia. This opinion unsealed just weeks before the trial is set to begin on September 12th.
Time now for what to watch next week. On the earnings front, investors will have their eyes set on Disney. This comes amid a tough year for the House of Mouse. Disney Parks business slowing along with declining subscribers for Disney Plus. All the while, the fate of ESPN remains to be seen. Investors will also be gearing up to hear from Lyft. The ride-sharing company feeling the heat after Uber reported its first ever operating profit. Meanwhile, Rivian and Lucid will offer investors a closer look on where the EV makers stand in the face of rising competition. Other names set to report quarterly results include Paramount, Roblox, UPS, and meme stock AMC. Shifting over to the economic front, expect new reads on inflation. The Consumer Price Index to deliver insights on the move in prices for July. The Fed will be keeping a close eye on whether the easing inflation trend continues. This, of course, coming while the Fed reiterates its determination to bring inflation down to its 2% target. That'll do it for today's Yahoo Finance Live. Be sure to come back here on Monday, 3 p.m. Eastern. We'll have all the coverage leading up to and after the closing bell. Have a great weekend.
Have a great weekend, everyone.